Hello, I'm Greg Miller. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that boost your trading potential. Coming up, are we nearing a major market top or just seeing some normal volatility? Chris Vermeulen says defensive stocks are flashing warnings, big tech leadership is weakening, and a deeper reset could be taking shape. He joins us in just a couple minutes. We're going to discuss the levels that matter the most. Plus, with Nvidia earnings next week, options traders are pricing in a big move. Recent stock softness adds to that tension. We're going to show some strategies for both the bull and bear cases. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour of the trading day. Let's jump into the platform. Take a look at the S&P 500 right now. We've had a little weakness out of the gate, but we seem to be getting back up towards the break-even line. We got earnings to digest, also the Iran tensions catching the focus of investors. Let's take a look at the heat map. No better way to see the push and pull in the market right now as to where we might be headed, as to what the heat map is showing us. Nvidia, Apple, Meta, JP Morgan, some of the financials are lower, but then some of the other tech plays as well. So it's a really mixed board, and you get that whole sense of a market just looking for some direction. Earlier in the week, we told you about Walmart that would be reporting. I think Hiram was talking about it just yesterday. The holiday quarter sales rose nearly 6%, earnings and revenue better than Wall Street's expectations. They saw gains in e-commerce advertising. Their third-party marketplace boosted the business. Right now, you got the stock on the move higher. It was interesting in the pre-market because the current fiscal year earnings outlook fell short of the street's expectations. Market was trying to decide whether they liked this one or whether they didn't. Right now, you got Walmart up about 2% on this news. And that's your market update. Joining me now from London, Ontario is my colleague Hiran Amin from our direct investing educational team and technical analyst Chris Vermeulen, founder of the Technical Traders. Thanks for being here, gentlemen. Guys, before we jump into the conversation, just want to remind our viewers that the views and forecasts expressed are solely those of Chris and his team at the Technical Traders and based on their research. Chris, this has been a choppy 2026. We saw this big run up in precious metals, then a big correction. Tech is losing leadership. Money is rotating into defensives. So a lot of people have this question. This is the first question I'll pose to you. Is this indicative of something bigger happening, a market top, or just some regular volatility?
Yeah, well, that's a big question. That's the one everybody really wants to know. Now, when we step back, look at the big picture, it feels like we are getting closer to a major market top. But as you mentioned, the rotation we're seeing into defensive plays right now, the big move we've seen in precious metals, those are all signs that the market is nervous. It doesn't mean the end is here. We're going to have some big bear market start, but it's definitely, there's a lot of warning signs saying that. And right now, we're not seeing panic selling or anything. We're just seeing typical money doesn't know where to go. And so it generally goes to where people are comfortable. Utilities, consumer staples, even the real estate sector ETF is doing well. People go to what's comfortable and what they know is always going to be needed and be around, even if we have a recession. So money's nervous. The S&P 500 has really been trading more or less sideways since the October high. So we really haven't gone much of anywhere, and people are getting tired of this sideways choppy move. And so they're looking to go elsewhere because the stock market is looking like it could have a bit of a correction here at any point.
You mentioned the money moving towards utilities, staples, and healthcare, real estate, other parts of the market. Historically, when we take a look at those more defensive plays, is it a reliable signal that this rotation means that there's a bigger correction coming?
It generally is very reliable. I find when utilities dramatically outperform the S&P 500, we tend to see a sharp correction in equities, usually within a week or two of that point. And so we've hit that threshold. We have seen utilities have a very strong rally. They have now hit resistance. They're showing a little bit of weakness. But the outperformance compared to the S&P 500 and the NASDAQ is big enough that it's telling us big money is trying to get protected. A lot of money in the market, you know, most advisors and funds, they have to stay in the market. And so they can't just exit when they're nervous. So they are positioning. It looks like the money flows are positioning. They're trying to brace for impact. And we've seen this over and over again through many cycles, through just before major 10 to 20% corrections in the market, we see utilities outperform. We tend to see gold do well, consumer staples. All of those are happening. So it is a very accurate sign in terms of, I think we need to be aware this market is on the cusp of a fairly significant pullback. And the Magnificent Seven could lead the way there. Well, I believe they are leading the way. They've already broken down, and they are going to pull the indices down dramatically. They're about 9 to 11% of the stock index itself. And so if they fall, which looks like they could go down about 15 to 20%, it's going to pull the S&P 500 and the NASDAQ sharply lower and trigger, I think, a wave of panic selling. And I think that's what big or smart money is positioning themselves for.
Chris, actually, let's talk about the MAX for a moment. You know, I guess the way you've kind of positioned it is maybe it's the kryptonite of the market. You know, big tech is no longer the leader of the, no longer the alpha dog of the market pack. So just based on what you just mentioned, if we see the MAX 7 starting to roll over, I mean, we've just seen sideways price action, choppy range right now. By your estimates, do I have that correct that you've said about like if they roll over, you could see the S&P come about 9 to 10%, or is there any further pressure that you think it could, systemically push into the other indices as well?
Yeah, I mean, I've got charts here of the Magnificent Seven ETF to get a visual of that. And when we look at the Magnificent Seven, there's a very significant support level kind of right through this chart around this $62, $63 range. And of course, we have seen that broken on the Magnificent Seven. So it looks like they have put in a top. They have now broken down. And so I think this ETF alone, or the Magnificent Seven on general, could pull back about 20%. I think that, along with other equities selling off, because what's going to happen is when the Magnificent Seven start to sell off and the stock market starts to break down, it is going to trigger more selling than just the Mag 7s. People are going to start to unload a lot of other shares. So I think the S&P 500 could pull back 9 to 11%, but I actually think it could probably pull back more, 15 to 20%. Very much so like we saw with the COVID sell-off in the previous February last year. I think it could be something very similar, different reason this time. Last time it was news-driven. This time I think it's momentum has stalled out in the equities market, and it's going to be a wave of profit-taking, people protecting their capital. So I think it's a fairly significant thing we need to watch for, and the Magnificent Seven is under resistance and showing signs of weakness here.
Yeah. Well, and let's actually talk about sort of the tech space, but specifically honing in on AI. There's been recent weeks of news that sort of flooded the feathers about the software space within tech, this AI disrupting, kind of the moats that some of these companies have enjoyed. So from a chart perspective, do you think this is just sort of short-term volatility, markets just overcorrecting on this, or is there something structural revaluation that's taking place here?
Yeah, I do think there's definitely, I think there's a big movement taking place. I mean, there's the software sector ETF, which has had a huge sell-off, and software companies are now, they're getting very nervous. Shareholders are getting even more nervous, and we've seen that in the share price. If you look at the sector ETF, it's plummeted. It is now trading at a very significant support level here, and I think your comment about it being oversold, I think it's a little bit of an overreaction at this point in terms of share price. I think a lot of people quickly ran and exited companies and sold shares because of it. And now we're seeing the market kind of finding support. And now the market's trying to digest how is this going to play. And there's no doubt AI, I mean, I just read a report this morning, something in like the next 1 to 3 years, it could replace a massive chunk of services, of people, of jobs, really. Like, it's really starting to take over. All the free AI we see now is really just skim of the surface, super lagged. The paid services and what's actually going on and available is dramatic. And I don't think the general public realize how strong and how good AI really is when you dive into it. So I think it's a bit of an overreaction at this point. I think the market, this could hold up a little bit here. But if this sector breaks down, if we see the stock market move down another 10 to 15% or more, we're going to see this software sector break through support, and it's going to plummet fairly significantly. And it's definitely going to shock the software system, the software sector in a big way, and probably change the way a lot of companies start to look at the future because, I mean, I know they already are, but AI is definitely going to be hurting their share price, and that's obviously not what they want to see is their share price, investors losing confidence.
Chris, I'm going to add AI now to my laundry list of things I threw at you off the top in terms of dramatic moves we've seen in the market, trying to figure out what's next. Gold and silver, I want to get back to those. Big dramatic moves, big pullback. The US dollar, if it continues to firm, how vulnerable are these metals?
Yeah, well, the dollar, when you look back, over the past year or so, it has formed a very large, you could call it a bear flag, meaning the dollar index could have a very big leg to the downside, which would spur another big rally, I think, in precious metals. I don't feel like that's going to be the case. The chart is also forming what looks to be this bear flag pattern could also be a bottom, a base. And if the dollar firms up and the economy starts to weaken, we tend to see the US dollar do very well. So I think we're going to see the dollar find a bottom and start to break out and post a very big gain. And I think that's all going to fall onto, we're probably going to have some bad economic data or some type of data that comes out that pivots the market sentiment, and people become bearish on the economy, they become bearish on stocks, and the dollar takes off. We see this happen over and over again through crisis. The US dollar rallies. That will break, I think, precious metals down, put a lot of pressure on them, and I think we could see a very big correction in both gold and silver to the downside as this happens. I still think there's some work to be done, probably several weeks or a couple of months, but overall, I think the dollar is going to want to firm up and have a very substantial rally. And of course, that's going to take the wind out of the precious metal space.
Yeah. Great. And Chris, let's just chat about the dollar for a second, because you mentioned it may be bottoming out. We saw it sort of kiss that, I think it just a couple of weeks ago or a week ago, about that 96 level on the DXY, the US dollar index. So if it does rally, what kind of level are you looking for? What does it need to break above, and kind of what does that mean for a risk appetite again? What do we suddenly see risk appetite on and with the dollar firming up, or is it still going to be muted even though the dollar is going to rise?
If the dollar rises, I actually think it'll be a weakening in the economy. I think people will be closing their wallets, tightening up. I think stock market will be falling. I think the dollar is a great place to be. Sometimes one of the best positions, which a lot of people don't see as a position, is a cash position. Instead of holding something falling, why don't you protect your time, protect your money, and move to cash? And then the big question is, which is why we're on this topic, is which currency do you hold? Now, I'm in Canada. I believe the US dollar will strengthen as the economy and things get ugly. So I want to move into the dollar. I think the loonie or the Canadian dollar will fall. I think our economy and the currency will collapse very quickly. So I want to be sitting sometimes in cash in a currency. And as a Canadian, we could see potentially a 15 to 17% rally in the currency exchange alone. So sitting in the right currency as an international trader can post some pretty good gains. So I think the dollar will firm up. If the dollar firms up, I think a lot of other things are falling apart, and it's just going to be a safe haven type of play that, depending on your views, it's also a trade as well.
You talk about safe havens. We talked about the money rotating into traditional things like utilities and consumer stocks. There's also a renewed interest in micro caps. Now, would you consider this to be healthy risk taking, or is this really just late cycle speculation?
I believe it's late cycle speculation. We saw this back in 2021. The market started to get comfortable and feeling like it was going to start another big rally and push higher. We saw small caps and micro caps actually spike and break out and have a very big push. And then it only lasted a couple of weeks and it reversed. And then we went into the 2022 bear market, which lasted about a year, and equities had a very big sell-off. So I think there's a lot of people moving into the micro caps. Now, we've had this huge move in precious metals, and a lot of those mining stocks and those companies are kind of in that micro space. So there's a lot of volume, a lot of people moving in. But when people move into the most aggressive stocks like micro penny stocks, that is usually a sign they're very bullish. And I'm a bit of a contrarian indicator. I follow sentiment very closely. And when we have all the things that are unfolding now, kind of on a macro event with gold and other defensive plays, and we've got big technicals breaking down like the Magnificent Seven, yet people are piling into the micro caps to make a bunch of money. That is what we saw in 2021, just before the market rolled over. So I feel like people have this false sense of confidence, and they're swinging for the fences, not realizing it could unwind in a big way. So I see it as a bearish sign, and we just have to let the market eventually top and roll over here. But you don't want to be betting on the market falling just yet. The markets are still in limbo. We're trying to figure out which way all the markets are going, because long-term, precious metals are still in an uptrend, but short-term, they're very bearish. And the equities market is the exact same. The long-term trend is still up, but short term, it looks very bearish. And that's where we have this confusion. What do we do? And we don't know. We really have to see which way the markets are going to break. That's utilities, consumer staples. That's real estate. That's where money goes when they don't know what to do.
Let's talk about some of this sort of hesitation that's there with kind of choosing a direction, Chris. You obviously track the moving averages. I know you're big on looking at the 150-day on the longer term, the 50 and the 20-day moving averages. So, if we're trying to read the tea leaves, I know it's a futile exercise, but is there any technical shifts that would give you conviction that we've entered a true bear market? Obviously, then the theoretical 20% drawdown. But is there anything else you're looking at besides just the sectors that, from a technical perspective?
Yeah, well, I mean, the biggest thing as a technical trader is price. That is the number one first gauge. Price has to break down. So we need to see the S&P 500 and the NASDAQ break through support. They have to be making a series of lower highs, lower lows. That's the definition of a downtrend. So price does have to be pointing in the right direction. A lot of people, because the markets are kind of mixed right now, it's like the train is at the station and you just walked into this train station and you've never been there before. You don't know which way that train is going. A lot of people jump on it saying, I believe this is a pause and we're going higher. A bunch of people jump on it saying, I'm shorting it. I think the market's going down, but they have no idea which way the train is going. And so the best thing to do is I like to follow the 50 and the 20-day moving averages. I think they're very powerful. If the 50-day is sloping sideways or down, especially if the 20-day moving average crosses below it, then we are more or less in a downtrend. It's a very simple way using those two moving averages, which way the train is moving. And so I always wait for a trend to reverse. I don't try to pick a top or a bottom. I use technicals to follow, not predict. And that's where a lot of people get it wrong. They jump on a train hoping it's going to go in the direction. I wait for the train to start leaving and I run and I jump on that train going, okay, that's where it's going. I want to go that way. Here's how I'm going to play it. So that's the big difference. And the moving averages, the 15, 20-day are a great way to know if you're in an uptrend or a downtrend and put the odds in your favor.
Chris, we've covered a lot of ground to sort of top it all off. People are hearing a number of these things and wondering if it's time to get defensive or is this just a kind of shakeout that if you say longer term we could get a nice big upside move out of it. How should we be thinking about this as investors?
Yeah, as a big shakeout, it's as a long-term investor, it really depends on your time frame. I mean, if you're a buy and hold investor, you really got to wait for some major trends. Well, you're going to hold it through everything anyway, but as a longer-term investor, we have to let more damage happen to the charts. We don't want to be stepping out of the markets just yet. We're still long the S&P 500. It's clinging on to just a thread of an uptrend. And so you want to be long this market. If we do start to see it correct, potentially that first wave down, that 10, 15, 20% correction, depending how it recovers from that, it'll turn the tide from a correction, and it potentially will tell us, okay, this is the start of a bear market. So it's going to come down to how price moves, the volume, the money flows across different sectors, and position and risk management. Most people don't really apply, kind of risk management. Most people just kind of buy and hold, or they kind of swing for the fences. You do need to have strict rules. If the market does fall a certain amount, you just have to step aside. Sometimes we're wrong, and that's part of the game. And so you really need to follow these trends. Now, the short-term trends right now are pointing down, but as a long-term investor, it's not something you would jump out. We need to step back to the bigger picture trends on the weekly chart to identify, is this the start of a new bear market? And if so, then you might want to step aside. So you have to look back at a bigger picture as an investor, and more damage needs to be done before we know that train has actually changed direction.
Chris, always great to get your thoughts and your insights. Thanks so much for joining us today.
Thanks for having me. Pleasure.
That was Chris Vermeulen, founder of the Technical Traders. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only. It should not be considered investment advice or buy, sell, or hold recommendations here, and lots of interesting stuff there from Chris. I want to get back to that idea of the way we see money rotating, the traditionally more defensive parts of the market. So that's generally a pretty reliable indicator of the market. Might be on the cusp of a significant pullback, but at the same time, right at the end, saying but that train hasn't left that station in either direction yet. So we got to keep looking at the charts, looking at the price action.
Yeah, exactly, Greg. I mean, we're trying to look for tea leaves, as I mentioned, like looking for what we could predict would be the next sort of moves that would happen in the market. But it's like looking at sort of the parts of the sum that really put it together. And that's looking at these spaces that you mentioned, utilities, consumer staples in particular. One thing that actually caught me off guard was when he was talking about the dollar, and if we do see a bullish run on the dollar, how that's going to be a negative for the economy, of course, because we know that makes export American everything priced in dollars. Obviously, those exports or imports more expensive, but it also means he was saying that this could shake up the equities market as well if we do get a stronger buck on the cards there. So that's another one to just keep an eye on, see where those levels are. It hasn't moved a whole lot, but it's interesting how he mentioned as well, going to the dollar, using that as kind of a hedge if you're kind of unsure of where the market is, and if you want to stay in the sidelines and especially if you're bullish, of course, if you think the dollar can go up. So that's just another thing to sort of look at in this space that he had mentioned. And then just coming back to the technicals, Greg, the last thing that we wrapped up with is looking at those higher time frames, which is one thing that I think we should all enforce. Is it's easy to kind of look at the minor minutiae of the days, but when you want to look at is the bigger picture, the weeklies and the monthly closes, and that's really going to help us shape up kind of where that direction of the market's going to take us.
Another great interview and definitely one worth re-watching. But wait until after we're done the show right now. If you at home have a question for our guest or team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website where you can try out the platform risk-free. You open a practice account, you click on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export the workspace, start trading for real. We have been talking technicals. Let's do a technical take now on what's happening with Nvidia. Set to report earnings next week. Kieran, what are the charts telling us?
Yeah, let's chat about Nvidia. This is supposed to be like the blockbuster outcoming of earnings, right, Greg? When it comes out, Nvidia has defined the AI revolution for almost 5 years now. Its chips are what's considered to be the de facto benchmark and essential to power everything AI in this world. So this quarter, it's not so much about whether Nvidia can beat expectations. It's going to be about whether management can convince investors that the AI growth cycle remains structural rather than peaking. So the key issue that whether management can convincingly argue is the AI capex is still in the early innings, especially after we've heard some of the hyperscalers announce some of their capex spend. So for this quarter, next week's earnings will be on Wednesday after the market closes. This will mark their Q4 26 earnings. Estimates are at $65 billion on the revenue side and EPS of $1.50. That does mark a 65% year-over-year growth. And margin expectations on the gross margin expectations are expected to approach the 75%. The big one, Greg, for everyone to keep an eye on out of the segmentation of the revenue is going to be data center revenue. That's projected to come in at $60 billion, and gaming is supposed to remain stable at the $4 billion, which has been what it's been for the last few quarters. So now it's also about the forward guidance whenever you come to earnings, as I mentioned. So Q1 27 is going to be important. They've already come out with predictions, $75 billion in the revenue, $1.65 on the EPS. So that's really where you want to hear where the story is going to come around. Management also has to signal continued hyperscaler demand. We'd want to hear more about that. And expanding enterprise adoption and strong Blackwell and Rubin ramp visibility. These are their sort of flagship GPUs that they have. Blackwell's the current iteration of it. Rubin is the one that's going to come out next. So that's what we want to hear about. But they've also been making the news rounds, Greg. This week, Meta announced we're thinking all this CapEx spending, it's not so much of what's going to be spent on, but who's going to be the recipient of that CapEx. Well, we should hear if Nvidia is getting some of it, but at least by Meta's account, they're going to be getting some of that thrown their way. And then, of course, they're making inroads and hedging against China with the news this week that they've now really boomed into India. India is making a big dent into the AI space, and Nvidia is a big part of that growth story. So let's look at the charts, though, Greg, and see what the story is, because even though we've painted this sort of backdrop, it doesn't seem to resonate with the charts. When you look at the charts of Nvidia, the best way I've described it is just trendless. It's just been a little bit of choppy range-bound price action. You can see coming out of the April lows, we went on this strong bullish run after it hit, broke below that $100 level and made a huge run. Once it started getting to this 170 level, we started going sideways in the price action. You can see, as evidenced by our moving averages, similar to what Chris uses, I've used a similar average. I've got a 150-day, I've got the 50-day moving average in blue, and I've got the 21-day average in yellow. And you can see the 21 and 50-day, they're just in sort of an entanglement right now. they're not really picking a direction. It's going sort of sideways. We saw the price top up at 212, and then it fell from grace and dropped back to the 170 level and kind of just hugging around the 185. This is an important level because this represents on a volume profile basis a heavy volume trade at this 185 level. So going into this earnings, what I am looking for is, you know, the upside expected move is going to be about roughly $15. So we want to see a clean break above this 195. One thing I want to point out is since the last earnings, we saw this big bearish candle, and the high on that move has marked the key resistance. We've seen like a wall of sellers just hit at the 195. Anytime the price comes up, we've just seen the sort of ass being whacked over here, where we see a lot of selling pressure come in. So it really needs to break this 195, and then we could possibly test out to the 205 and maybe touch the 212 on the high side. On the downside, the key level is going to be the 170. If it falls from the 185, 170 is the area of demand. But if it breaks the 170, then we could be in for a steeper sell here. One thing I'll also note on the last basis is we're forming what's known as a descending triangle pattern, Greg. This is usually seen as a bearish sort of reversal sign, where we've seen the price action narrowing within this. We did have a break, but I would categorize more this as currently as a fake out because we haven't had conviction and making a higher high. So if it resumes back within this triangle pattern, the downside break of the 170 is going to be the key line in the sand to hold.
All right, we got that chart there. We got our lines all over it. You're going to walk us through a couple ways we could trade Nvidia. Before you get started on that, though, Hiran, just want to remind our viewers that options trading carries high risk. It may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Where do you want to start, bear or bull?
Let's start with the bullish story, Greg. So I'm just going to switch my charts for a moment here. So if you wanted to play the upside, and if you think there's potential with some of the sort of tailwinds that are coming into this earnings, one of the strategies you could look at as a trader is a long call butterfly spread. So this is again going to be a directional trade, Greg. We are looking to have an upside move happen here. Part of the reason we want to go directional on this trade is we look at the implied volatility profile. Right now, it's sitting on the lower end of its implied volatility sort of scale that it has on the 29th percentile. Expected move on this earnings, I said 15, but it's about $14, rounded up to 15. So on the top side, we could see if it breaks. Currently, Nvidia is sitting at about 187. That means it is going to touch and breach that $200 level. So this trade, essentially what it is it comprises of 3 option legs. We're looking to buy the 190 strike, which is just out of the money at the moment on the call. We want to give ourselves a little bit more time so that we minimize the effect of time decay. And then we want to sell where we think the next level of resistance could be. Now, this is going to be sit around the previous high. This is a 212, but remember the close was at that 210 level. So we're looking to sell 2 contracts of the 210 over here for the same expiry cycle. And then further off to cap our risk, because we're doing two sells over here, we're going to buy one more 230 on the other side to keep an even spread of $20 width over here. So essentially what this trade is, we're looking for some upside move, but we're looking for a muted upside move, I should say, within the time frame that we're looking at. So we wanted to get up to 210, but we don't want it to really go past 210 because then it works as a double negative for us. We start losing money. It starts chipping into our gains, I should say. Not losing money, but we do lose money if it does break past the 230 level. And let me break the numbers down, Greg, because we want to see what it actually means. What do we stand to gain over here? So first things first, this trade is a net debit trade, so we're paying money into this trade. In this case, as of pricing, as of last night's close, it was $4 on this to put on this butterfly. In other words, $400 in a single contract. That puts our break even at $194. So we need the price to at least get up to $194 for us to start becoming profitable on this trade. Now, the max profit situation is going to be if it takes kind of a break right at the 210 level within our expiry time frame. So if it kind of lingers in that 210, we make the max profit. So it's really calculated by taking the width, $20, minus what we paid. That means $16. In other words, $1,600 on a single contract. The loss, however, is going to be what we put into this trade. In this case, it is $400. So either if the stock breaks below 190 and stays below 190, we lose out on the $400, or if it breaks above 230, it's almost a scratch trade. We would still be out of our initial debit that we paid on it there. So that's the bullish trade for you, Greg.
A butterfly for the bull. How about the bear?
All right, so for the bear, we're going to do something similar, directional trade again. So in this case, what we're looking to do is we're looking to put on a long put condor strategy. So again, the profile and everything still makes sense. It's a lower implied volatility profile. We're expecting about a $14 to $15 move. So what this trade essentially is it comprises of four legs, I should say. So let me lower it up here. So we're looking to buy the 190 put. We're looking to sell the 170. This is our previous key support level that we eyed. So we want to see at least a fall down to this level. And then we're just giving ourselves some distance, because if it does fall, we could see some chop and maybe find some support back at 160. So we're looking to sell the 160 and the 140. Now, the reason I want to do this is, some call me cheap, but I like to call myself cost disciplined. I want to minimize how much I'm paying for this trade, especially around an earnings period. And so what this does, it helps us bring in some extra credit for what we're paying over here. And overall, this trade is going to cost us $5.50. So that means our break-even price is $184.50 on the downside. That means Nvidia has to break below $184.50 by our expiry. We're going on a short expiry for this one, March 26, and then we start making profit from there. We keep on making profit till the 170 zone. So in this case, if we take our width, again, it's a $20 width, even distance. We stand to make $20 minus what we paid for it, $5.50, and that's going to be $14.50. In other words, for $1,450. And on the loss side, always when you're dealing with a debit trade, the loss is going to be if the stock doesn't fall, stays above 190, or if it breaks below 140, then it works against us, then we will lose the debit we paid, $550 there, Greg.
All right, interesting ideas there for our audience. That is the show for this week. As always, investors should perform their own due diligence before engaging in trading. We will be back next Tuesday with the bear bull debate. And what are we talking about next Tuesday?
We're talking about TJX companies, more formally known over here as winners, Greg. So I know it's helped me sort of come up with my fashionista look when I come on the show. So we'll be putting them to the test and see if there's actually sort of more discount fashion, fast fashion space is actually working in its favor there.
The pants I'm wearing right now may or may not be from the winners just of Bay Street. All right, that's what we'll talk about next Tuesday. Thanks for watching today. We'll see you then.